Hello. We will be waiting a little bit until people come in, perhaps just half a minute or so, then we will start formally. Okay, let's start. So welcome to our year-end webinar. We will go through what we take away from 2021 today, but also try to give as much forward-looking perspectives as possible. You can see here we have put together a team of our best analysts. So my name is David Wech. I'm Chief Economist here at Vortexa. We also have Jay Maroo joining us, our lead crude analyst.
Hi.
Then we have Richier, our lead freight analyst.
Hi, everyone.
And last but definitely not least, Serena Huang from Singapore, our head of APAC analysis.
Hi, everyone.
Okay, so some of you may already know, basically you will have access to the slides and to the recording. You will get that afterwards. You can ask questions already potentially throughout the webinar. We will try to look at them at the end. We have some 15 slides prepared, so we may take up to 45 minutes today, and let's see how many time for questions we have, but we will try to do our best. Yeah, so let's kick off. You may have already had a look over the topics here, so I won't go through that at this point of time anymore, and let's basically go right into it. At the beginning, I do want to talk a little bit about Omicron. I think that's impossible to avoid, and I also think it's pretty important. We would see it as more relevant as what you may take away from the IEA and OPEC reports, and also from some commentary in the broader media. As you know, there are basically three factors that have to be considered. That's how easy it transmits, and that's very clear. It transmits very fast, about 3 to 4 times as fast as the Delta variant. The second is how severe the infection is you get. There is a very widespread hope that the infection will be less severe, the illness will be less severe, but the truth is also that, at least according to virologists, this is a hope at this point of time. It's not something that is definitely confirmed. And the third thing is basically the risk of reinfection, breakthrough infections, and that's also pretty firm that it is way higher than with previous variants. So the point is, the two relevant aspects are the first and the last, I would say, especially the rate of transmission is crucial. So the point is that I think it's very likely that we will get high frequency waves that are overcharging health systems around the globe. And the difference basically to earlier waves will be that these waves occur at all places at the same point of time, very fast behind each other. The UK is already on track within, I think, a week or so that Omicron will be the dominant variant, probably even faster than what was initially thought. And it's spreading in many other places as well, including also the US, even though that's perhaps not yet that widely noticed. Just to make this point again, even though if it may very well be much less dangerous, so to say, or from an individual perspective, if so many people get it, then there will be also a lot falling ill, and it can also not excluded that it basically mixes up in individuals, or at least in the society, at the same time with the Delta variant. or with an influenza wave in the winter period in the Northern Hemisphere. So the huge amount of infections at the same point of time will be the crucial thing. And that's also where ultimately oil demand will be affected. We have already now first countries in Europe closing down schools again. I think that's something that is likely to spread. You know, so far we are not seeing the impact in terms of hospitalization rates, but this will happen, you know, about the lag, and it's really a very new virus, as you know. So a guess, and that's just to be also very clear, it is simply a guess, is that about something like 2 million barrels per day of oil demand could be affected in the first quarter of next year. So that's would be significantly more than what IEA and the others are telling. What should be considered here as well is, of course, that it's difficult to reflect such a new threat so quickly in these big reports that have a lot of statistics behind them and so on. So I don't think it's necessary telling their opinion or the opinion of the analysts behind that they haven't changed yet their demand assessments in a significant way. Looking a little bit at the balanced perspectives, it will nevertheless be a largely anticipated demand shock. So refiners are definitely looking at the repercussions. As soon as they are seeing less sales, they will cut back operations, and OPEC will also closely monitor the picture. And even if officially they have not changed their output policy, I think it's pretty likely that they will actually cut back supplies if they see basically less demand and the reason for it. Now, let's with that also come to the good news. And again, of course, it's speculative, but the Omicron variant has typical characteristics, basically, that mark the transition from the pandemic to an endemic stage. So I think all scientists are saying the same. The coronavirus will stay with us. It's just basically a question of when it is so widespread that the populations are simply used to it, and the severity is so low that it doesn't really make anymore a big difference. And this chance after these fast waves, basically globally in the first and potentially still into the second quarter, the chance is then that we have really a full recovery happening as of the second half of next year. Of course, there's still numerous other risks like supply chain issues, inflation, stagnation, and so on. So we would think that there is further room for downside in prices of that, but we would think that something like $60 per barrel is probably a level where oil prices would bounce off. To make a quick comment on the slide here and on the basically other factor that has put a little bit the heat off the oil markets, that is simply, even though it's perhaps somewhat difficult to see here, but a pretty steep increase in seaborne supplies of oil and gas around the world. That's about 5 million barrels per day additional seaborne supplies over the last 3 months. And it comes across the board. So there is additional crude in here. There is, of course, additional clean products. Also, the LNG supply share is growing. And all this comes really after a long period of essentially stagnation throughout the first 9 months of the year. So these additional supplies are simply cooling the market. Now, let's move on into an overview of what happened a little bit from the freight perspective.
Thank you, David. So looking at freight markets in 2021, we've clearly got a tale of two markets, with clean tankers having benefited more from a pronounced recovery in those seaborne clean volumes versus their crude and dirty tanker counterparts. So if we look on the left-hand side chart, we can see crude ton miles across tanker classes compared to 2019 have remained well below their respective averages, kind of similarly to the volumes as well, to crude exports. It's important to note that throughout the year, most of the demand for crude was met by stock withdrawals. So those stocks that had been built up during 2020 and the start of 2021, when crude was cheap and freight was cheap as well. So with the price of crude recovering, that gave even more incentive to rely on those reserves, and that really hit seaborne demand hard. We can see over Q2 and Q3, we've actually had a worsening of the situation as crude volumes on the water sort of flatlined. China as well added quite a lot to that development with a clampdown on independent refiners, on top of that, limiting those imports. Now, it's not all doom and gloom as my background suggests. We have witnessed a rise in crude exports end of Q3, start of Q4, which enabled increasing volumes out of OPEC Plus, especially out of the Middle East, which has helped the market improve. But we can see there's still a long way to go before that full recovery. And here we can sort of beg the question as to how far OPEC Plus can shoulder this recovery further in 2022. Now, from a ton-mile perspective, what's important to note is that those volumes out of the Middle East as well contribute much less to distance traveled, and that keeps employment duration short compared to, let's say, loadings out of the US Gulf or West Africa. Now, on the right-hand side of the chart, we can clearly spot a much rosier trend for clean tankers. We've had increased refinery runs throughout 2021. We've had recovering demand for transportation fuels, such as gasoline, diesel. That's really helped clean tankers do better and even improve compared to 2019. Now, we can see that concerns mainly MRs and LR2s. The former have benefited from increased activity in the east of Suez, in the Atlantic Basin. And for the latter, it's those LR2s employed on longer distances that have benefited from the likes of robust naphtha demand throughout the year as well from Asian refiners, for example. Now, going back to crude, Jay, whom do we need to watch to save my crude tankers from a repeat depressing market in 2022?
Thanks for that, Arthur. So let's look at what's happening with crude supply, what's happened. And the main theme here is one of divergence between regions and between countries. So if we look at the chart on the left-hand side, what we've got here is seaborne crude and condensate exports. And what we've done is we've benchmarked that against the average for 2019. And the reason we've done that is because we want to get a proxy as to how close we are to pre-pandemic levels. And 2019 average is somewhat a useful measure for that. We've divided how we look at crude exports on the basis of looking at it from the perspective of OPEC only exports in blue. And then we've got the plus aspect of OPEC plus, so i.e. Russia, Azerbaijan, Malaysia, and some other smaller producers in green. And then we've got the global total in yellow just to serve as an indication. And what you can see here from this chart is a strong divergence in the trends between OPEC and the plus countries when it comes to the recovery. Naturally, OPEC has led the way in bringing crude back into the market post-pandemic, and you can see that from the upward trend here. But that trend has got some key nuances to it. And those nuances are made more clear in the right-hand side chart. And what we see here is the importance that Saudi and the UAE are playing in lifting OPEC crude exports. And that's evident from the total rise in volumes, which you can see in the bars, but you can also see in the green that UAE and Saudi, their share of total OPEC exports has increased massively from 2021 onwards, from the tune of like 43%, closer towards 50% by the end of the year. That's a reflection of the fact that obviously Saudi has more spare capacity than anyone else, but it's also a reflection of the fact that other key producers within OPEC have really struggled to lift their production, even in a rising global oil price environment. So with that, let's turn our attention to the next slide where we can look at those dynamics in a bit more detail. So the one key example of structural decline is on the left, where we see what's happening with West Africa crude exports. And you can see that since Jan 2020 onwards, there's a steady decline in what's happening with the total crude exports exported from the region, Nigeria and Angola, of course, being a key component of that. Underinvestment has really played a role here, a structural role in preventing these exports from lifting higher, even when crude exports have, when crude prices have recovered this year. And we see that in the news, there's been numerous delays, specifically with Nigerian loads of late. And there have been comments about recoveries expected in December and then January, but the broader outlook is one of structural decline, in my opinion. So what's the impact on this at a global level when it comes to the arrivals? And we break that down by sweet and sour. Obviously, West African crude is generally sweeter in nature, and the barrels coming out from OPEC are medium sour or more sour. So if we look at what's happening here on the yellow line, you can see the impact of that slowdown in West African exports for east of Suez refiners. And that's a decline in these flows heading from West Africa to east of Suez, especially China. That also hasn't been helped by the fact that gasoline margins are weakening. So the propensity to import sweet crudes from China had weakened of late. And that's in sharp contrast to what we see in west of Suez. So if you look at the difference in trend for what's happening with the blue lines, the dotted and the solid lines here, you can see a convergence between sweet and sour imports. And that's really interesting when we look at it from a broader perspective, what's happening with energy prices, specifically natural gas. What we can see here is the impact that it's having for especially European refiners, where there's a preference for sweeter crudes because of the lower desulfurization costs that we see here. Going forwards into 2022, we think that these energy costs will be a key theme. And there is a chance that as the recovery takes place, especially in the second half of next year for Asian imports, given that that's going to be led by OPEC medium sour imports, there may need to be more sweet imports at the margin for that to balance out. And so maybe there's an increased likelihood of Atlantic basin crudes heading into east of Suez destination. So example being maybe US light sweet crude, more Johann Swedrup, potentially 40s, and maybe Brazilian medium heavy sweets heading increasingly into Asia in the next year. So with that, let's focus a bit more on what's happening within the most important Asian buyer, namely China. So I'll turn to my colleague Serena on that.
Thank you so much, Jay. Well, so if we look at the global refining sector and really starting off with China, now this year really marked a turning point for China's refining sector, especially in the second half of the year where a slew of policy changes were implemented. So it started off with the introduction of consumption taxes on a couple of blending components, followed by the significant reduction in crude imports as well as product exports for the respective refineries. And we believe that this has led to a marked slowdown in China's crude imports as well as clean product exports, especially in the second half of this year. We believe that this trend will continue to show through to next year. And on this basis, we think that China's refining sector will face growing headwinds as the government closely moderates refining runs, and also the demand uncertainty going into next year. So talking about refining runs, they are likely to be continuously moderated by crude imports and product export quotas that are likely to be on par or below 2021 levels. Why do we think this is so? Because right from the start of next year, we have the Beijing Olympics, and it is in the government's strong interest to maintain blue skies during this period. So what we think is that refining runs, especially around the provinces of Hebei as well as Shandong provinces, will likely be regulated or curbed to control the air pollution within the region itself. And for the rest of the year, the government will continue to push towards cutting excess refining to achieve its emissions targets. So on this basis, crude imports and refining runs will be tightly regulated. The phasing out of smaller and less efficient refining units will continue, as with previous years. And we believe that refining with capacities below 40 KBD are really under threat of closure. As of late, there are over 115 refining units with capacities of less than 100 KBD, and these capacities are also likely to be phased out in the next couple of years. Now, if we look towards demand, the outlook for demand isn't too optimistic. While China really had a very strong performance in terms of its economic growth this year of about 8%, next year, the IMF actually forecast that economic growth will slow to about 5.6%. And this is on the backdrop of a slowing manufacturing sector, the constant disruption to supply chains, as well as the rising financial risks itself. Now, it doesn't help that the country has adopted a zero COVID strategy, which means that whenever there are rising cases, the government will be very quick to impose lockdowns, and it will have a direct impact in terms of the domestic demand, and we could potentially see increased volatility as a result of this strategy. So to sum it all, China's refining sector will continue to be regulated and rationalized in next year, and it could potentially see growing headwinds coming up from demand uncertainties within the country itself. So with that, I'm going to turn the time over to David.
Thank you. So now we will do a little bit of an exercise in order to try to understand the economics that are behind refining runs in the different places. China is really a special case because there is so much interference, so to say, and steering from the government. In many other places of the world, it is really more down to the economics. Now, we are looking here, or we're splitting up basically the refiners into three types of refiners. We are looking at oil producer refinings, and for the purpose here, we look at the Middle East, the United States, and Russia. So this is the blue bars down here, and we are actually focusing on the standard refined products: gasoline, naphtha, jet kero, and diesel. You can already see here that these countries have seen a strong increase in their supplies, in their exports, basically, of clean products. The second group we're looking at is refining hubs, in Asia and in Europe. We have included here Singapore, Belgium, Netherlands as pretty clear examples. India, South Korea, and Italy, you can perhaps be discussed a little bit whether they should be part, but they have strong, so to say, partly integrated refining systems that have a strong and that are also somehow located on trade routes. And then there is basically the rest of the world. Perhaps from a starting position, it's interesting to see that the refineries from this just relatively limited amount of countries altogether make up a pretty strong majority of the overall clean product exports. Now, in order to understand what COVID has done to the refining runs and to the operations, we look here again at from our export perspective, and it's very clear that initially all these refiners were hit more or less in equal parts. Operations and exports came down quite significantly. What is then interesting that in the first phase, basically, it was particularly the rest of the world refineries that somehow came back. So we had here a period around the last winter where these refiners were actually exporting more than in the 2019 average, which is the basis again of the analysis. That may have been because they may have seen the demand come back and have increased their runs in line with local demand signs. But what has happened then is basically that the oil producing refiners have really taken over. There have been these exceptions over August and September, and that was really a lot to do with US hurricanes and also refining maintenance in Russia. But generally speaking, you can see that there's a clear trend. There is one set of refineries that have produced more and exported more than in 2019, which is those located in the oil producing countries. The hubs are more or less flat over the last 3 months at least versus 2019, and especially over the last 2 months, the rest of the world, that's typically refineries close to consumption, to local consumption, have really lost out again. Not so different, actually, even extend to the early COVID phase. Now, what is the reason for that? We think the key reason is simply everything related to the cost of refining. That starts with the feedstock, like crude oil, that is cheaper in the producing country, but evidently very important. It's about energy costs. Natural gas plays a huge role. You may know that natural gas prices, when you measure them in terms of LNG prices in Asia or Europe, are currently something like 7 or even more times more expensive than in the US. And of course, local prices in Russia and the Middle East are also much lower than the international market prices. The external or the natural gas is important because in many refiners, not in all, but in many refiners, it is used as an external source of power to power the units, to heat the units, to generate the steam, but also very specifically to produce the hydrogen, significant part of the hydrogen for desulfurization purposes. The IEA estimates that these costs they may add $4, $5, $6 per barrel to the processing cost for every barrel of crude in places that are exposed to these high gas prices. And it's important to understand that these costs are not part of the standard refining margin calculations you're looking at. Another thing that is recently coming in is the carbon allowances in places like Europe, in particularly, which add also another $1 or so due to the record pricing. the crucial point here, or the final point, is that we do expect LNG prices to remain pretty lofty, at least over the winter season, but probably also at multiples of the US levels throughout the next year. And that will basically continue to provide the support to the refining hubs in producing countries, and at the margin continue to put pressure on those refineries closer to the consumption areas. Now, the prime example, so to say, of a refining sector in a producing country is the US. And it's, on the one hand, perhaps not surprising, but on the other hand, I think it's again and again important to reflect how much of supplies the US is adding to the market. So we're seeing here on the left-hand chart the total export level of oil and gas, including also LNG in the yellow bars, and how this has increased. And to make this point even clearer, we're looking here again versus the 2016 average. Yeah? So basically, recent values, November, December, are about 7 million barrels per day higher than what has been exported in 2016. Of course, there is a chunk of LNG, which usually you wouldn't count on a barrels per day basis in there, but it's also more than 3 million barrels per day of additional crude oil, nearly 1 million barrels per day of additional LPG, and as I mentioned before, crucially, basically from exporting less diesel here specifically and products over the late summer, autumn period, we also now see here a clear increase, and that's making a crucial difference for refining margins.
Thanks, David. So now we've talked about China, what is happening in for the rest of Asia. So over here we looked at Northeast Asia and India's crude imports, as well as Southeast Asia clean product imports, as an indicator of their demand within the respective countries as well as regions. And what we see is that for the first 3 quarters of this year, both regions were pretty much mired by the Delta variant pandemic that really hampered oil demand recovery. And as we see from the charts itself, the historical imports this year is still much lower than the 2019 levels that we see. So there is really room for oil demand to really play a catch-up over here. But what's really interesting is that, with rising vaccination rates and falling COVID cases, with countries reopening and moving towards an endemic basis of living with COVID, we started to see a recovery of the oil demand in the respective regions, particularly for India as well as Southeast Asia. Now, while we wish that this nascent demand recovery and the momentum could continue into next year, but there is really a lot of uncertainty surrounding whether this demand recovery will continue because of the threat of the Omicron variant, as well as rising inflation that could potentially, dampen consumers' demand and appetite. So if we move on to the next slide, what is really important for Asian refiners' survival is a positive and a favorable export arbitrage. And we see it playing out this year. So on the chart on the left-hand side, you see Asia refiners' clean product exports out of the region in the blue bars, as well as Singapore's clean product stocks in the orange line. And what we see is that, starting from this year, product stocks in Singapore started on a very inflated level because of COVID last year. And what really kept product cracks and refining margins low was because of the elevated supplies and the stockpiles within the region itself. But what helped is that, because of the positive export arbitrage, a lot of the flows from Asia actually were sent to the West, and that actually drew down the inventories and tightened the supplies within the region. So we actually see it cascading and creating an uplifting effect on the refining margins. If you look at the chart on the right-hand side, where we show the refining margins for complex refiners in orange and the simple refiners in blue. So between the period of July and October, right, refining margins more than doubled. And that's the effect of more product exports flowing out of Asia, but at the same time also the significant cutback in China's product exports that really helped boosted the refining margins. While the simple refiners also saw refining margins lifting, but we note that refining margin still remains in the red, and it could continue to do so in next year, which means that a lot of these simple refiners may potentially face the threat of closing down next year if they do not receive further government support itself. And for the refiners, another threat or another risk that they're facing is the rising energy costs, especially for refiners that depend on importing gas, as what David mentioned. So for the refiners itself, first of all, this underscores the importance for Asian refiners to have an outlet out of the region to export their surplus products. But second of all, in terms of refining economics, next year could be one which is fraught with volatility because of demand uncertainty as well as the high energy prices. So with that, I will turn back over to you, David, to share with us some of the interesting trends of the changing clean product trade flows globally.
Thank you for much better passing over than I do. Now, yeah, quickly we see here two repercussions of partly also, or what we also expect as repercussion from changing refining economics. So if we look at South America, we see that the imports from Asia and the Middle East have been very strong this year. So this is very long haul movements, but we expect the US to come back here strongly and claim back market share. And to a certain extent, we see this trend already happening over here. On the other hand, Asian volumes may anyway be well, how to say, parked or used in the Australian market, which generally sees an increasing trend in terms of clean product input requirements. And it may simply, in line with the economic trends, we see more sense if the refiners basically keep the barrels in a more nearby market than rather sending it around the entire world. Arthur, any comments you would like to add on that?
Yeah, absolutely. So on the shipping side, I think it's been really interesting what's been happening. Now, traditionally, that route for CPP cargoes from Southeast Asia to Australia is mainly catered to by MR tankers, so your 30 to 40 KT cargo size. However, with increasing demand for refined products, as we've seen, this has brought LR tankers into the fray, so closer to 60, 80 KT cargoes, as buyers are really seeking to maximize those economies of scale. And why wouldn't they? This is literally why shipping exists in the first place. So we can see that share over 2021 really rising, so close to 40% at some point, before going back down around the 25%. Now, it could be argued we're talking about one route, one country. You wonder what that means for the bigger picture. Well, these increasing numbers of LR tankers is really taking tonnage away from your more established routes like Middle East to Japan, in turn leading to freight rates strengthening throughout the year on this benchmark trade. Now, this also takes away capacity on the Middle East to Europe clean route traditionally served by LRs. So you see where I'm going with this. You've got this somewhat innocuous change in one part of the world, which is arguably one not often in the spotlight, further afield, which is having a huge impact on freight rates globally for this tanker class. And it's probably set to continue into 2022 with the potential for increasing amount of clean volumes out of India, for example, potentially heading down under. So let's move out of the Oceania region now, and Jay, back at you for an Atlantic Basin demand overview.
Perfect. So we had heard previously about increasing flows of India heading to Australia. And actually, when we look at what's happening on the diesel picture, that's probably a nice way to balance what we're seeing with Russian diesel exports and potentially US diesel exports. So Russia's naturally the largest supplier of diesel to Europe. And the country's exports have been increasing significantly in the past few months. Some of that is seasonal, but the fact is exports are pretty strong, and they're more than likely to head increasingly towards Europe. And in doing so, they'd probably crowd out exports which previously had come from further afield from east of Suez refiners. We heard David earlier talk about the strength of US refining and its recovery. And that's another factor potentially for European diesel buyers as well, which could bring more US Gulf Coast diesel barrels heading into Europe in the coming months. And that would follow this trend where we see on the right-hand side chart of increasing Atlantic Basin diesel arrivals. So that's a really interesting trend, because in the past, what we had seen is that Atlantic Basin arrival increases were driven or supported, by Indian flows or Middle East flows heading into Europe. But that's coming under increasing threat, especially with the recovery that we see in Pacific Basin imports since August to to November on the right-hand side in the yellow. Looking ahead, given that we're in winter, obviously the demand for diesel for heating purposes goes up. So that's key to watch, given what's happening with Singapore and Malaysia with their role as a strategic diesel storage source for the wider Southeast Asian region. If we kind of zoom out at a global level, if we look at what's happening with global diesel margins, probably a lot of strength for diesel margins to increase in the coming months, especially once we head into a period post-pandemic, maybe in an endemic world, especially if we see the wider trend of both Atlantic Basin and Pacific Basin diesel imports head upwards. So with that in mind, obviously there is some room for optimism on clean tankers. But Arthur, what's happening with the availability of these tankers in the order book for next year?
So perhaps if I interfere, let me just say one additional thing on what this chart also tells us about the demand level. I think it's really important. I mean, you may have heard, people from trading companies talking about demand being back to 2019 levels. And I think this really comes from the markets that are basically behind the strong diesel inflows into the Atlantic Basin here. So we had strong demand in North America. We had strong demand in Latin America, mixed in by a lot of power shortages and agricultural demand related to that. We have recent months very strong demand from West Africa, and we have also a solid recovery in the European markets. So basically all these came together, and that was basically driving this type of idea that the market is back to 2019 level. But what was really missing, and is still partly missing, is simply the Asian part. And in spite of the recovery Serena mentioned in Southeast Asia, there is still potential there. So we are not yet fully there, and the market would really, so to say, heat up if both regions fully combine strong demand. But there is some seasonal upside, as Jay mentioned, from the heating perspective, but there is also some weakness in there related to Omicron and to the lack of agricultural demand in the coming months. So Arthur, sorry.
No worries at all, David. So let's actually start by looking at freight rates. And if you look at the chart on the left-hand side, comparing freight rates across those vessel classes, we can clearly see an uneven start to the year. There was a spike at the end of Q1, but that was very short-lived. It was followed by a very weak summer and autumn, where rates suffered from prolonged lockdowns and inactivity around the world. Now, we previously mentioned the picture had improved in Q4, and we can see that momentum, which seems to be more steady across both crude and clean tanker classes. Now, Q4 is seasonally a strong quarter for tanker markets. That seems to have held true, even as OPEC plus hiked their output at planned, and demand for heating fuels as well, such as diesel, rose. Now, it's worth bearing in mind again that tanker rates are rising from what have been very low levels. And it's not only weakness compared to exceptional earnings that you had late 2019 or during the first half of 2020. The reality is that average freight rates across those 5 tanker classes, in some instances, have reached 5-year lows. Over the summer, we were consistently below operating expenses, especially within crude tanker segments. So that means negative earnings. So it looks good, but it's still got a long way to go. Now, going back to your question, Jay, the supply side of the equation is really what worries me more. If we look on the right-hand side, 2020 is going to be a massive year in terms of new build deliveries across all major tanker classes. And that is simply going to keep a lid on any further improvement. Now, while scrapping has started to show some promise, we've seen the numbers of tankers scrapped in that second half of the year really accelerating. It would really have to dramatically accelerate, sort of counter that, what I say is a tsunami of new builds expected in 2022. According to Braemar research, we've got about close to 190 tankers due for delivery. And across these 5 sort of major classes, we expect to see fleet growth in excess of 5%. Now, that's all things equal, not taking into account once more demolitions. But that is definitely something to bear in mind. Now, we've also witnessed something interesting in our data, and that's the average speed across the fleet. We can clearly see that downwards trend on this chart. We've got the industry sort of readying for a number of deadlines that are approaching to make ships more efficient, to meet environmental guidelines. And so slow steaming could gather more steam, forgive the pun, as a practice, sort of mitigating somewhat that impact of increasing supply. Now, on the back of that, if you just look at that Q1 2025 number, which is sort of growing, that is the silver lining that I see, not necessarily in 2022, but beyond, where we've now got orders as far out as 2025. So shipyards are full with orders for container ships, dry bulkers, because these segments have done much better. So ordering has been much stronger. So that could really be something to look into in the next couple of years, where that supply of tankers then is really being relegated to 2025 in terms of orders. So looking ahead, we do expect tanker rates to have bottomed out in 2021, but that doesn't necessarily mean they're going to sort of steadily recover through 2022. But then again, we've got very low oil and refined product stocks. We've got recovering demand. So we expect maybe the second half of 2022 to be more positive. So I previously mentioned OPEC Plus and questioned how much further they could go to really support that recovery. David, why don't you take us through that to finish off?
Yeah, a quick look, so to say, back here. So I think what is important has been simply an important feature that it took up quite a long period of time until they really came up with additional supplies. Yeah, and the reason behind this has partly been the declines in West Africa and other markets. The question basically that leaves is, how many of these players do have spare capacity? And if we look here, basically how the supply has developed over the last 1.5 months versus the 2019 average, once again, you can see that there are two countries that are supplying now already more than in 2019, and that's Saudi Arabia and the UAE, but all others are supplying less, and it's partly significantly less. There are a little bit of question marks. There may be room in Iraq and Kuwait, but otherwise you can see here that many players, they are far behind where they have been in 2019, and they are far below the quota as well. And the point is simply, why would they supply less than they're allowed within the OPEC framework? And the reason is simply they cannot more. Yeah? And I think this is simply a very important topic. It comes after years of a lack of investment. It comes related to the uncertainty from COVID, but also all the environmental concerns and so on. So there is simply much less investment going on. And the trend that has been established well over 2019 and into 2020 in OPEC crude supplies to the market in terms of exports, it may simply be, it can simply expect it to go on like this, and the true level of OPEC capacity is surely not here. Yeah, it may also very well not be here, and we may actually, so to say, not be too far off here right now. Now, over the next couple of months, first half next year, we don't see this to be the big issue in the market based on our view on Omicron and on the upside that's still there. But in the second half of next year, we think that this can very well become a hot topic again. Now, many thanks for your time so far. We do have a summary slide that tries to sum up the main ideas, but it's rather thought, so to say, for your reference later on. As said, we will send you the slides, and we would like to open the floor for questions at this point of time to answer. Is anybody who would like to pick up one?
Sure. So we've had a question come in about VLCCs loading from east of Suez and heading into Europe carrying diesel. And the question is, what would happen? How do we see it in 2022? So this is actually a really interesting phenomenon where new build VLCCs load clean, even though they're normally meant to be used to carry dirty. And then they go on a super long haul voyage around the Cape into Northwest Europe or West Africa to discharge. What's our view on 2022? Well, I think there's two things to consider here. One is what's happening with the east to west arb on diesel. And given how things are right now with this kind of imbalance in demand recovery, but also the imbalance in potential refining costs for bringing diesel over from east of Suez to west of Suez, I think it's unlikely that at least in the very short term, we'll see a lot of VLCC head towards Europe. What could change that is in the coming months where as demand improves, what we could see is that there is an increasing need for US crude or North Sea crude to be loaded on these new build tankers to head back to Asia. And so when they come out fresh from the shipyard, rather than ballasting to pick up that US crude or ballasting to pick up that North Sea crude, maybe they want to load it up with diesel just to make advantage of that relatively cheap freight. So maybe in the second half of the year, that could be more of a phenomenon. The counterbalance to that is obviously looking at the slide that we previously saw from Arthur, is that the amount of new build VLCCs coming in the second half of the year is obviously lower than there is in the first half of the year. So yeah, it's definitely one to watch.
Yeah, Jay, I just also want to jump in here to say that, if we look at the product stocks, at the start of this year, it's really, really very high, which means that, Asia was really, huge or supply overhang for diesel. And, that gives a lot of the Asian refiners the incentive to actually push the surplus out on VLs over to the West. Now, towards the end of the year, at the moment, distillate stocks within the region are pretty tight. For Singapore, if I recall correctly, the distillate stocks are at the lowest since 2018. And which means that, supplies within the region are pretty tight. And we've seen that, with the drastic reduction in China's diesel exports and, South Korea picking up. But a lot of these South Korean diesel cargoes, they are directly heading into Australia, where the demand center is, right? And demand is pretty robust in Australia. There isn't a really, a strong build-up in diesel within Singapore itself. So, Jay, agree completely with your point that, at least for the short term, we don't really see, BLs being chartered to load clean out of Asia to the West itself.
I think to round up that question quite nicely on the freight side, it is important to look at, so not only the pull for diesel, like Jay and Serena have just mentioned, but the push on the supply side as well, where you're simply going to be earning much more as a ship owner carrying that clean cargo. So I believe the incentive will be there for these owners on their new build voyage to try and capture that compared to I think what is still today negative earnings on the spot VLCC market.
Yeah, I'm also picking up on that's the question basically why spare capacity would be relevant if the IEA is forecasting that oil supply will increase by 6.4 million barrels per day next year. The point 2 points I would like to make there quickly is that on the one hand, this assumes that OPEC production will increase basically back to its historical levels. That's the point I just made, which is pretty unlikely to happen. And the other is what has been mentioned before, that stock draws have been so much of a factor in meeting demand this year. So basically, the chances are pretty good that demand will be strong in the second half of the year. Bringing in another question is basically about China and the reaction specifically in that country to the Omicron challenge. Basically, so far the country has really tried to avoid infections as all, and the question is, with the high rates of transmission, whether this will be possible going forward. And there is surely the risk that trying to continue that approach could really block economic activity in a way it has already happened in the past. So that is definitely something to have a look at, and that's part of the reason why we do think that demand will really be affected in the first half of next year, especially in the first quarter of next year.
I'm going to pick up the question regarding occupancy issues at shipyards. And absolutely, we touched upon it on the slide looking at the supply dynamics. I think tanker markets are going to expect a massive supply squeeze in 2023 and beyond. Then again, we will have had a lot of new deliveries in 2022, but as is correctly pointed out, if those rates of scrap steel remain very strong, there's a lot of older tonnage to clear out. We haven't touched upon the issue of Iran, but if Iranian sanctions were to be removed, I don't necessarily see it as a positive for flows, and I don't expect a large amount of volumes to come onto the water. But I do expect that to spur a lot of older tonnage sort of be cleared out of the market. So absolutely, I think 2023 will be interesting on the supply side for tankers.
Yeah, I would say then many thanks, Alpha, Jane, Serena, for great contributions. Many thanks to all out there for taking the time at this part of the time of the year where everybody's busy. There is a survey afterwards. We would be appreciate greatly if you could answer. I think it's just 2 or 3 questions. Should be very fast. As said, we will provide the slides and the recording to you. So feel free to refer to our presentation going forward. Yeah, many thanks again. And if you want to see more of the data behind all these nice charts we showed you, please reach out to us, get a demo of our services, yeah, let's stay in contact. Many thanks. Bye.
Thank you. Bye-bye.
Cheers all.
Thanks. Bye.